Okay, let's unpack this. Imagine trying to juggle your own household budget for a month. Every coffee, every bill.
Yeah, you can probably get a handle on that, more or less.
Right. Manageable. But now, think about a massive business. Thousands, maybe tens of thousands of transactions every single day.
Instantly impossible for one person. Your brain just can't hold all that detail.
Exactly. And that's really the starting point, isn't it? That basic human limit is why accounting isn't just some, bureaucratic thing. It's essential.
Absolutely indispensable.
So that's what this deep dive is all about today. We're looking at the theoretical framework of financial accounting. We're using university course materials as our guide here.
And the mission really is to cut through the jargon.
Yeah, get past any feeling that it's overly complex. We want to give you that shortcut to understanding the real why, what, and how of it all.
So that why indispensable? Well, beyond just memory, like we said, it's about control.
Control. How so?
Think about it. If you own a huge company, maybe with thousands of shareholders, you're not there every day. How do you make sure, things are accounted for, that assets aren't walking out the door?
Ah, right. Accountability. Preventing theft, making sure managers are doing their jobs properly.
Precisely. You need a system. Systematic accounting provides that. And it's not just about control, it's about information.
Information for who?
Well, everyone involved, really. Inside the business, managers need it for planning, for making operational decisions, seeing what's working.
Okay, internal decisions. Makes sense.
But also external folks, like banks deciding whether to give you a loan. They need to know if you're solvent.
Or the tax authorities, I suppose.
Definitely. And this applies everywhere, not just big corporations. Schools, hospitals, charities, they all need it.
So if we zoom out a bit, what are the big goals? The core objectives?
Well, first, just keeping systematic records. Every transaction, what you own, what you owe, just getting it down reliably.
Okay, the record keeping.
Second, figuring out the bottom line. Did the business make a profit or a loss over, say, a year? That's your profit and loss account. Kind of like the business's report card.
Got it. Performance over time.
Third, knowing the financial position at a specific moment. What does the business own and what does it owe right now? That's the balance sheet. Think of it like a financial snapshot.
Report card and a snapshot. I like that.
And finally, the fourth objective is just reliably getting all this info out to the people who need it, the users.
Okay, so how does it actually do all that? What is accounting defined?
It's really a whole process. It starts with identifying relevant financial events, then measuring them usually in money terms, then recording them.
That sounds like bookkeeping so far.
Exactly. Bookkeeping is sort of the initial data entry part, recording and classifying. But accounting is broader.
Broader how?
It includes summarizing all that data, analyzing it, interpreting what it means, and then crucially communicating it. It's the whole journey from raw transaction to useful information.
And what about accountancy? I hear that term too.
Right. Accountancy is more like the body of knowledge. The principles, the theory, the why behind the how of accounting. It's the discipline itself.
Okay, that clarifies the terms.
Yeah.
So who are these users getting the information?
Oh, lots of different groups. Owners, obviously. They want to know about profits, financial health. Managers, like we said, for decision-making.
Lenders.
Lenders, yes, checking if you can pay back a loan. Creditors deciding whether to give you goods on credit. Potential investors, is it a safe place for their money?
Tax authorities.
Even employees.
Yeah, employees often want to know if the company is stable, job security.
And does accounting look the same for all these different needs?
Not entirely. That's why we have different branches. Financial accounting, which is mostly our focus here, is geared towards those external reports for investors, lenders, etc.
Okay.
Then there's managerial accounting, which is all about internal information for managers' decisions. And cost accounting, which really digs into the cost of making products or services. Right. So, focusing on financial accounting, what are its big strengths? And maybe, what are its weaknesses?
Okay, advantages first. It replaces unreliable memory, provides control, makes preparing financial statements systematic. It helps meet all those user needs we just talked about.
Allows comparisons too, right? Like year over year.
Yes, comparison is key. It helps management plan, deters fraud, helps with tax stuff, even valuing the business if you want to sell it.
Seems powerful. But limitations, what doesn't it do?
This is crucial. It mainly deals with things you can measure in money. It doesn't really capture, say, the quality of your management team or your brand reputation or employee morale.
Important stuff, but not on the balance sheet.
Exactly. Also, it's largely based on historical cost, what you paid for something, not necessarily what it's worth today.
So it can be a bit backward-looking.
It can be, and there's subjectivity too. Accountants have to make estimates and judgments sometimes. Plus, it usually gives you the overall profit, but maybe not why one product line is doing great and another isn't, unless you dig deeper.
Okay, that makes sense. Now, I've heard about different bases of accounting. Cash versus accrual.
Right. Two main ways to time the recording of transactions. Cash basis is simple. You record revenue when you get the cash, record expenses when you pay the cash.
Sounds straightforward.
It is, but it can be misleading. Imagine you do a ton of work in December, send out invoices, but don't get paid until January. On a cash basis, December looks bad, January looks amazing.
But the work was done in December.
Exactly. That's where the accrual basis comes in. It records revenue when it's earned, when the work is done or goods delivered, and expenses when they are incurred, when you use the resource, regardless of when cash changes hands.
So it matches the effort and the result in the same period?
Precisely. Most businesses use accrual because it gives a much truer picture of performance for a specific period. It matches revenues and the expenses that generated them.
That seems much more logical for understanding performance.
Generally, yes. And for this information, whatever basis you use, to be actually useful for you, the user, it needs certain qualities.
Like what?
It needs to be understandable, relevant to your decisions, reliable, you can trust it, comparable, so you can compare it to other companies or previous years, and consistent, the company should use the same methods over time.
Understandable, relevant, reliable, comparable, consistent.
Got it. So wrapping this up, the big takeaway is that accounting isn't just bean counting. It's a really sophisticated system for information and communication. It's the backbone for understanding almost any organization.
And getting a handle on these core ideas, even just the basics we covered, really empowers you. You can look at financial news, company reports, and make much more informed judgments.
Absolutely. It helps you see behind the headlines.
So a final thought to leave you with.
Yeah.
Accounting is traditionally looked back, using historical data to guide current decisions.
Right, the historical cost principle, the focus on past performance. But we live in a world that's increasingly real-time, constantly changing. So how might accounting need to evolve? How can it provide more dynamic, maybe even forward-looking insights beyond just those historical reports to keep pace with the speed of modern business?
That's the big question, isn't it? Something definitely worth pondering.